A former SSA agent just revealed the 3 Medicare traps that hit retirees in the first year. And I need you to stay with me for the next few minutes, because if any of these apply to you, the window to fix them is shorter than you think. There is a woman in Ohio who spent 31 years as a nurse. She retired at 65, filed her Medicare paperwork, and thought she had done everything right. 3 months later, a letter arrived from the Social Security Administration. Her monthly Medicare premium was not $202.90. It was $284.10. Nobody had warned her. Nobody at the enrollment office had mentioned it. The system had looked at her income from 2 years earlier, when she was still working full-time, and quietly added an $81 surcharge to every single monthly bill she would receive for the rest of her life, until she qualified for an appeal. She had walked into the first year of Medicare believing the traps were behind her. They were in front of her the entire time. That is trap number 1. And there are 2 more exactly like it. What I'm about to walk you through came directly from a former SSA agent, someone who spent decades on the inside of the enrollment infrastructure and watched these same 3 situations destroy the financial plans of people who had done everything else correctly. He said the same thing every time I pushed him on who gets hurt. He said, the people who get hit hardest are the ones who are careful. That is what makes this so important. The first trap is called the 2-year lookback, and it is the one that catches retirees at exactly the moment they feel most prepared. When Medicare calculates your Part B premium, it does not look at what you are earning right now. It looks at the income reported on your federal tax return from 2 years prior. That number, your modified adjusted gross income from 2 years ago, determines whether you pay the standard premium or whether you owe what the government calls an IRMAA surcharge, the income-related monthly adjustment amount. In 2026, the standard Part B premium is $202.90 per month. The moment your 2024 income crosses $109,000 as a single filer, or $218,000 as a married couple filing jointly, that number jumps. And it does not phase in gradually. It is a cliff. $1 over the threshold and the full surcharge applies, adding $81.20 per month on top of your standard premium for Part B alone, plus additional surcharges on Part D. Here is the specific situation the former agent described most often. A teacher, an engineer, a nurse, someone who worked a full calendar year right up until retirement. That final working year produces a tax return that looks nothing like what retirement income will look like. But Medicare does not know you retired. It sees the return. It applies the formula. And the surcharge arrives in the first year of coverage, when the retiree is already adjusting to a fixed income. The protection exists. It is called Form SSA-44, a life-changing event appeal. If your income drops significantly because you retired, you can file that form with documentation of your new income and request that Medicare use the more recent figure instead. Most people never file it because they do not know it exists. The former agent said that was the single most underused tool in the entire system. The second trap is the one he said caused the most permanent damage, the Part B Late Enrollment Penalty. Medicare gives every eligible person a 7-month window to enroll in Part B, 3 months before the month you turn 65, the month of your birthday, and 3 months after. If you miss that window and you do not have what the government considers qualifying coverage, the penalty is 10% of the standard monthly premium for every full 12-month period you were eligible but did not enroll. And under federal guidelines, that penalty is permanent. It follows you for as long as you have Medicare. At the 2026 standard premium of $202.90, 2 years late adds roughly $40 per month to your bill for life. 5 years late, and the math becomes something most people cannot absorb when they finally understand it. The trap inside the trap is COBRA. The former agent was unambiguous about this. When someone leaves their job and continues coverage through COBRA while delaying Medicare enrollment, they are not protected from the penalty. COBRA is not qualifying coverage under the Medicare rules. Neither is most retiree health insurance from a former employer. The only coverage that delays the penalty clock without consequence is active employer-sponsored insurance based on current employment, yours or your spouse's. The moment that active coverage ends, a special enrollment period begins and the clock starts. Missing that window even by weeks can lock in a surcharge that compounds across decades of retirement. The third trap is the one the former agent said keeps him up at night because it involves money that belongs to people and they never know to ask for it. Medicare Savings Programs are state-administered benefit programs that pay some or all of a beneficiary's Medicare costs, premiums, deductibles, co-payments, for people who qualify based on income and assets. In 2026, the Qualified Medicare Beneficiary Program covers individuals with monthly income up to approximately $1,350 and assets under $9,950. The Specified Low-Income Medicare Beneficiary Program extends that threshold to roughly $1,616 per month. These are not obscure programs. They are funded specifically to cover the gap between what Medicare costs and what some retirees can afford to pay. According to the Medicare Rights Center, millions of eligible beneficiaries never apply, not because they investigated and did not qualify, because no one told them these programs existed. The former agent described what he called the asset confusion problem. Many retirees with a small savings account and a modest social security check assume the numbers are too high to qualify. What they do not know is that countable resources under the Medicare Savings Program rules exclude a primary residence, one vehicle, personal belongings, and in most states, certain retirement accounts. The calculation most people do in their head, adding up everything they own, is not the calculation the program uses. A retiree who believes they have too much to qualify may be sitting inside the eligibility window and walking away from coverage worth thousands of dollars a year. He said it plainly, the system does not automatically enroll people who qualify. It does not send a letter explaining the program, it waits for an application, and the people who need it most are usually the people who never learn to ask for it. What connects all three of these traps is the same thing. They are not punishments for doing something wrong. They are the cost of not knowing something specific at a specific moment in the first year of a system you have been contributing to your entire working life. The two-year lookback hits you because your last working year looked different than your retirement will. The late enrollment penalty hits you because COBRA felt like the safe choice. The Medicare Savings Program gap hits you because the program does not recruit, it waits. The former agent's last words in our conversation was something I have not been able to stop thinking about. He said, "The first year is the year the traps are all active at once. After that, most of them lock in permanently. If someone is going to get this right, they have to get it right before the window closes." Form SSA-44 for the IRMAA appeal. Documentation of active employer coverage if you are delaying Part B. An application for Medicare Savings Programs before you assume you do not qualify. 3 pieces of paper, 3 conversations. The difference between a retirement that works and one that quietly costs more than it should have, every single month, for the rest of your life. Drop a comment and tell me which of these 3 you had heard of before today. I read all of them, and the ones that come up most are exactly what I cover next.